In this video, we're going to talk about how you estimate or predict the cash flows of a particular project. So let's just jump right into it and start talking about some terminology. We want to discuss or talk about the net cash flows, right? Of course, we're interested in taxes. So in the end, what we're looking to calculate is something referred to as the net incremental after-tax cash flows. So what does incremental mean? Incremental means that we have to decide what kind of project we have. If we have a replacement project, then we already have business that's going. So if we're thinking about replacing this asset, we have to look at two circumstances. What will happen to our company if we do not replace it? What will the future cash flows look like if nothing happens, we just continue on? But we also have to understand or predict, what do we think the company will look like if we replace the asset? So with a replacement project, we need to essentially predict two things: cash flows with the project and cash flows without the project. And of course, to find the incremental, you take the cash flows with the project and subtract the cash flows without the project. So again, this whole process requires us to estimate all of these different kinds of cash flows, if you will. Now, the three primary types of cash flows, we're going to estimate what does it cost to buy the project, the initial investment. The operating cash flows, of course, that's what we just kind of talked about, that's a prediction of the cash flows we expect to get on an incremental basis moving forward in the future. And then the terminal cash flow assumes that this project has an ending life. At the end of its life, we want to liquidate all of the assets. So if you kind of think about the timeline here, we start essentially with nothing. We predict some cash flows, and then we get back to the original point where we've sold everything we have, and now we're back to zero again. This should show us the net effect of buying the asset, using the assets, and then getting rid of the assets. So how these work with this incremental cash flow says, look, the initial investment is, what does it cost to get the new thing? If it's a replacement project, then we need to determine what cash flows will we get from replacing the old thing. We talked about the operating cash flows. We need to predict two sets of income statements coming and going, right? The inflows from doing the project, subtract from the outflows of doing the project, etc., to get that incremental cash flow. And then, of course, we need the terminal cash flows. Take the new asset, what will it cost to get rid of the new asset, or what cash flows will occur? But in addition, since we're looking for incremental, we have to also look at, well, what would have happened if I did nothing? At the end of this project's life, if I did nothing, I still need to liquidate those old assets. So it plays into our complete analysis here of thinking about, what will the cash flows look like if I do the project? What will the cash flows look like if I don't do the project? Another concept we have to think about is the differences between sunk costs and opportunity costs. Sunk costs are those things that we buy that even if we don't do the project, we can't recover those cash flows. And I think that's kind of hard to describe exactly what that means. I think it's better with an example. If we want to build a new building, then we're going to get an architect to draw up the building, right? Because quite frankly, we probably don't know what the building is going to cost until we get an idea of what it's going to look like and its structure. So we're going to have this architect do his plan. So what happens if this plan, the building's going to cost 20 million, but we only have 15 million? They're going to say, nope, we can't do that building. Does that mean that we don't pay the architect? And the answer is obviously no. They're still going to get paid. That's what's referred to as a sunk cost. Technically, we should not include that in the company's cash flows. Now, this is kind of a topic that's really up to the business, right? If the business wants to include sunk costs, it's their analysis. They can do whatever they want. Again, as far as if you're thinking about quizzes, homework, things like that, sunk costs should never be included in this analysis. Opportunity costs are things that we give up by doing this project. For instance, if we have some open space and we've been renting that space out for $50,000 a year, if we're going to put a project in that place, that means we lose that $50,000. That's an opportunity cost. And certainly we have to include that in the cash flows that we're estimating moving forward. So how does this work on an international basis, right? The techniques that we talk about are the same, right? It doesn't matter where you do this analysis, the techniques are always going to be the same. So what's different? Two things are primarily different. Number one is the currency, right? So again, we don't really care what the currency is. The numbers are what the numbers are. And if you're calculating things in pound sterling, at the end, your answer is going to be in pound sterling. So the answer to doing or not doing really doesn't change based on that. However, anytime we build or do anything internationally, we have to worry about political risk, right? This is the chance that the country that we're working in is going to upset our forecasts. I've heard of countries once, an industry will go in and try to build something like maybe they build a telephone system for a country, and they're expecting obviously to run that system and make money from the construction and the cash flows that come from that operating system, right? But the country then says, nope, I'm sorry, we're keeping the system, but you have to leave, right? That's a political risk. And there are some countries where that type of activity is highly probable. So we do have to worry about that and plan for those things. There is a concept of something called the foreign direct investment. This is the transfer of capital, managerial and technical assets to a foreign country, right? This is when a company, let's say a company in the United States, wants to build something in another country, right? That is a foreign direct investment. So let's again think about our costs that we're going to forecast. So the first thing we want to talk about are the initial investments, right? So there's two primary things we have to think about first. One, what does it cost to install this new asset? And I've used that word very carefully, right? So the actual cost of the new project is the cost itself, right? The actual cost of the new asset. But we also have to include any installation costs. whatever it costs to get this asset producing cash flows for the company, those are all installation costs. So our number that we're searching for is something called the installed cost of the new asset. And in previous videos, we've also talked about this as being the depreciable value or the depreciable basis. That's the depreciation we'll take on this new asset. So if we look at the cash flows, the total cash flows to think about in this initial investment, there were possibly three cash flows to consider. The first, as we've just talked about, the installed cost of the new asset. And of course, these costs are absolutely known. We know what they are. Now, if this is a replacement project, we have to determine what are the cash flows of getting rid of the old asset. Maybe it's like it's going to cost us, the asset is worthless, and it's going to cost me $20,000 to get somebody to tear it down and take it away, right? So it could be a total negative cash flow, but it also could be a sale, right? We could sell it for $50,000, right? So obviously that's what we receive, but we have to now decide whether or not there was profit made or not. And of course, that affects the tax on the sale of the old asset. And we'll talk about this in a second, how we calculate that. Next, the third thing we're interested in with our initial investment is, will there be any changes in our current assets and our current liabilities for the company based on this new project? If it's a new production line, we're going to have to buy inventory. So inventory is going to increase. A lot of inventory might be purchased with accounts payable. So there could be some offsetting there, right? So again, there's going to be some changes in net working capital. So again, let's work with this initial investment. How do you figure out the after-tax proceeds from the sale of the old assets? Well, of course, you know what the proceeds are. That's what you get paid. The tax determines, again, as I'm kind of repeating myself a little bit, but I want to make sure we get the pattern going here. There could be a tax on the sale of that old asset. It determines, or it's determined by whether or not we make a profit or not. So what do we need to know? The first thing we need to know is the book value of the asset. The book value is whatever the installed cost is of that asset minus whatever depreciation we've been able to take since we've owned it. That's its book value. Now, profit is just the selling price minus the book value. So let's look at an example here. I think it'll help us a little bit. So this, the spreadsheet pictures here come from something called the Capital Budgeting Depreciation Worksheet that's provided with some of my classes. So here we have the asset. It costs us $100,000 to buy this asset. It's a 5-year maker's asset, and we bought it 2 years ago. So the question we're asking here is, what is its book value? Well, in this depreciation worksheet, the first thing we have, and we've talked about this in another video, we need to know what the maker's percentages are. Now, depending on your data, sometimes these are listed in, as here, they're listed in 2 decimals. I've seen them in 3 decimals. I've seen them in 4 decimals. But you need to input them based on whatever your company uses or whatever table you're provided. But once you provide that in, here we have, it's going to show us for this 5-year asset, here's the depreciation schedule. Now it also, in this worksheet, it shows you what the remaining depreciation will be. And in the end, the book value is this original cost, $100,000, minus the depreciation we took, which you notice if you add those two together, that's $52,000. So the book value, it's down below here, calculates for us, is $48,000 for this particular asset. So we need to look at this for some different situations, right? So again, here we have that $100,000 asset. What if we sell this asset for $110,000? I'm going to expand this just a little bit so you can see better, right? $100,000, $110,000 what we spent it for. The actual cash flow is $96,880. Well, where did that come from? Well, without doing all the calculations, right, you received $110,000. That's greater than the $48,000, so we had to pay some taxes. So $110,000 minus the tax means that you actually net received $96,980. What if you sold it for $70,000? Again, $70,000 is greater than the 48, so net you're going to be able to spend from this $65,380. Now, your textbook talks about how this is actually broken down, but it's a very technical analysis. The important part from financial decision making is the tax rate is the same regardless of the analysis of how you label things. So we're most interested in what the net cash flow is, not that part of this is a recapture of depreciation and part of it is capital gains. If the tax rate's the same, it won't make a difference in our answer. Now, one of the things that is just a little peculiar, I guess, is what happens if you sell it for a loss? If you sell it for $30,000, that's less than the $48,000, which means you actually have a loss. So you're paid $30,000, but you'll get to reduce your taxes by the tax effect. In this case, by another $3,780, you'll reduce your taxes. So this is essentially a cash flow. So the formula here is it's the selling price minus the tax effect. And if the tax effect is negative, of course, when you subtract a negative from a number, it's actually adding to the value. The last thing we want to talk about quickly then is just the net working capital change, and that's just current assets minus current liabilities. So in this example here, we'll see the totals here. Here's the changes in accounts receivable in current assets of $22,000. You can just put the total there, a change in current assets, and then you put the total change in current liabilities. And later we'll see that that'll fall into our table here to show that our change in working capital was $13,000. So that's the first video in calculating the cash flows of a project. See you soon.